Hello, everyone. I'm Debbie Hatch, owner and CEO of Pinnacle Personnel Services, and I want to come on and do a Friday Night Live. This is at a request. One of my prior students and a subscriber on YouTube has asked if I could please talk about the TSP withdrawal options, specifically after we leave the federal government. But I wanted to expand that a little bit. So, what I'm going to talk about tonight are your TSP withdrawal options while you're continuing to work, or maybe you're in the military, and after separation. And separation here could be either resignation or retirement, either one. So while you're working, it's somewhat limited, right? This is a retirement savings account, and for the most part, they would like for you to save this money for retirement, so they make it somewhat difficult for you to pull money out as long as you're still employed. You can do a TSP loan where you are borrowing money from yourself. We have two types. There's a general purpose loan and there's a residential loan. I'll talk about both of those in just a minute. Also, while you're working, we have two in-service withdrawals. So you're still in the service of working, but you can now permanently remove money. For the loan, you're going to pay that back. For the in-service withdrawal, you're typically not. And I say typically because we've had some changes here since, they started when COVID started, and they've expanded since then. So two kinds of loans, two kinds of in-service withdrawals. Otherwise, while you're working, it's hands off. Once you stop working, we have a number of post-separation options that I want to talk about. Before we even talk about pulling money from TSP, though, I want you to be aware that the Spouse Equity Act, which was passed back in the early 80s, requires, if we're pulling money from a retirement account and we're married, that we notify our spouse. Not only that, but we get our spouse's permission before we are allowed to do the withdrawal. Under the federal government, our civilians have two potential retirement systems. We have something called the old system, or CSRS, the Civil Service Retirement System, and we have the new system, or FERS, the Federal Employees Retirement System. For CSRS employees, TSP is in addition to their retirement. For our FERS employees, this is considered to be part of their retirement. We have our federal annuity, which is our FERS portion or our retirement. We also have Social Security and we have TSP. And the three together are the total federal retirement package under the Federal Employees Retirement System. So if I'm under CSRS and this is in addition to my retirement and I'm married, I want to pull money out, my spouse is notified that I'm doing that. They don't have to agree, but they do have to receive notification. If I'm under FERS and I'm pulling money out, then my spouse has to concur, or I'm not going to be allowed to do that. Now, members of the military can participate in TSP as well. Those who have come in since 2018 are under BRS, so the Blended Retirement System, which functions similarly to FERS. So if I'm under BRS and I'm pulling money out, my spouse has to concur. If I'm under a prior military retirement, not BRS, TSP is in addition to my pension, then my spouse will be notified, but they don't have to agree. Okay, so before we even talk about what your options for withdrawal are, it's important to know about that spousal piece of things. Now, the loans. I am borrowing my own money. I'm not allowed to borrow the 1% that the government gives me. I'm not allowed to borrow the matching contributions. I can borrow my money and the earnings on that money. When I pay the loan back, it goes back into my account. So I take the money out, it comes out of my TSP account, I pay the loan back, it goes into my TSP account. Not only do I pay back the principal, but I also have to pay interest on my TSP loan. It's very low though. The interest rate for a TSP loan is whatever the G fund was paying when I took out the loan. So just look this up yesterday, it changes all the time. Loans against TSP in January 2023 have an interest rate of 3.875%. The minimum loan is $1,000. The maximum is $50,000. That's not 100% true. There's some flexibility in that, but it's easiest for me to say 50,000, so that's what I'm going to leave it at. And if you're interested in doing a TSP loan, you can certainly go to their website and look at the factual numbers for yourself. General purpose loan can be you taking out money for any reason whatsoever, so you don't need any kind of documentation. That's based simply on your signature. The residential loan, which is the second kind of loan that we have, is only if you are building or buying a primary residence. So you do have to have documentation for that one. For the general purpose, you can take up to 5 years to pay it back. For the residential, you can take up to 15 years to pay it back. Now, we had a change this past summer. Prior to this summer, if you took out a TSP loan and then you left your employment, you either had to pay that off within 60 days or it would be reported to the IRS as a taxable distribution. Now, you can take out a TSP loan. You can only do that while you're still employed. Once you stop working, you can't take out a TSP loan, but you no longer have to pay it off within 60 days. So if you take out a TSP loan just prior to retirement, you can continue to make payments on that loan even in retirement. Previously, you could not do that. So that's a nice change. There are a lot of people who are just going into retirement who may want to take out a TSP loan to pay off their mortgage or to do something like that. And in the past, again, they had to pay it off immediately. Now they don't. So that's a really nice change. You can have 2 loans out at any given point in time. It can be only one residential though. So you could have one general purpose and one residential, or you could have 2 general purpose, 2 loans at any given point in time. The in-service withdrawals, again, you're still in the service of working. You haven't left your employment yet, but now you're doing what is typically a permanent removal of money, unlike the loan that you're paying off. We have something called an age-based withdrawal. If you're still employed, and you are 59 and a half or older, you can do an age-based withdrawal up to 4 times a year now. You pay taxes on the money when you pull it out, but there's no penalty because you can't do that until you are 59 and a half or older, okay? In addition to the age-based withdrawal, we have had something called a hardship withdrawal, where the employee self-certifies to TSP that they're experiencing a financial hardship. They take out a minimum of $1,000 up to the full amount of the hardship that they're certifying to. And again, in the past, we couldn't pay that back. Things started to change during COVID. The maximum for the hardship went from 100% of whatever this financial situation was up to 125%. And the person had up to 3 years to pay the money back. That's unusual, right? This was a big change. They had up to 3 years to pay the money back. If they did, great, then there were no taxes paid, there was no penalty paid, and as long as they replaced the money within 3 years, good to go. If they didn't replace the money within 3 years, then they had 3 additional years over which they could spread the tax consequences. That is what we're seeing right now as well. So on the 28th of December, the 29th of December, the President signed the Appropriations Act, and it had several different things in there regarding retirement. I talked about those last week, so go back and check out that video if you haven't had an opportunity to do that. But one of those changes is the creation of something called an emergency withdrawal from TSP. So now, if we're still employed, doesn't matter how old we are, if we're having some type of a financial emergency, we can go and pull a minimum, it's always going to be a minimum of $1,000 from TSP. The maximum is the emergency that we're certifying to. Here, we do have to pay taxes on the money that we pull out, but we don't have to pay a 10% penalty tax regardless of how old we are. And just as we saw with COVID, I now have up to 3 years after I pull that money out to put it back. I did have to pay taxes when I pulled it out. So if I put it back within that next 3 years, I have to get a refund from the IRS, right? The taxes have already been paid, and I asked for that refund when I filed my taxes. But there was no penalty. So that's again the change that we're seeing, allowing me to put that money back, which previously I could never do, and also allowing me that 3 years over which I can put that money back if I want to, and I can get any paid taxes back refunded to me. Now, predominantly, what the request was is for me to talk about the things that you can do with your TSP after you leave your federal employment. So after you leave the military, after you resign or retire from civil service. One thing you can do is just leave your TSP sitting right where it is. You don't have to do anything with it until April 1st of the year after you leave your job, or April 1st of the year after you turn 73, whichever's later. It was 70 and a half, so if you have that idea in your head, that used to be correct, and then it went from 70 and a half up to 72, and with the most recent Appropriations Act, it went up to 73. 10 years from now, it's gonna go up to 75, so that's increasing all the time. When I hit that age, I have to start taking a distribution. I don't have to pull out all of my money, but I have to start pulling out some of it. To determine how much, the Internal Revenue Service looks at my account balance effective December 31st. They look at my current age, they look at my life expectancy, and they divide my account balance by the life expectancy. The total is my required minimum distribution. I can pull out more if I want to, but I can't pull out less, or if I do, I'm going to get in trouble with the Internal Revenue Service. Okay, so RMD starts at now 73. Until then, I can just leave my money sitting in there. I cannot contribute to TSP anymore directly because contributions to this account have to be made through payroll deduction, and I'm retired, but I'm no longer on the payroll. Now, I can pass some money through an IRA to continue to get things in TSP, but I can no longer just continue to contribute to TSP. And remember, while I can make loan payments, once I leave my federal employment, I can no longer request a loan. So this one is just talking about that RMD, right? I've already discussed it, but you see it there in writing. Right now, my RMD is required from both my tax-deferred TSP balance and my Roth TSP balance. Now, Roth IRAs do not have a required minimum distribution for the primary owner. Traditional IRAs do. So a lot of people confuse IRAs with TSP and think that it functions exactly the same. I don't have to pull from a Roth IRA, therefore I don't have to pull from my Roth TSP. I only have to pull from traditional. That's not true. Right now, this year, if I do a required minimum distribution, it does include both traditional and Roth balances. However, this is changing next year. This is part of the Appropriations Act again. Come next year, I will only have to do the required minimum distribution from my tax-deferred TSP account balance, but I will no longer have to pull from my Roth TSP account balance. This is the life expectancy table. I wanted to include it just so that you could maybe stop the video and grab the web address, but it's right on the IRS website where we look at that required minimum distribution life expectancy number. Okay, so I can leave my money sitting there. Longest I can do that is until I hit that RMD age, or I could decide that I want to roll my TSP into another tax-deferred account outside of the federal government. Maybe I have another job which offers me a 401k. Maybe I've established a traditional IRA or something like that for myself. I can roll those accounts into my TSP, and I can, once I leave my federal employment, roll my TSP into those accounts. Another thing that I might do is to take out my traditional tax-deferred TSP money, pay all of the taxes that I owe, and do a Roth conversion. Now, a couple of things that I want to point out with these as far as like, be careful. If you're doing traditional TSP, tax-deferred, to traditional IRA, tax deferred. You don't want to become the middleman. If that money comes through you, there's normally a 20% tax withholding. Now you've got 60 days to put it in the account. You can ask the IRS for your money back at the end of the year, but it's simpler if you simply do a direct rollover from account to account. That way, there's no taxes due, there's no penalty due, you don't have to settle up with them later because everything was taken care of on the front end. So that's one thing to be careful of. The other thing to be careful of is if you're doing a Roth conversion, money that you are converting to a Roth counts as taxable in the year you do the conversion. So if you're doing a large Roth conversion, you may have just pushed yourself into a higher income tax bracket and you now owe more taxes on everything else that you had going on. So you might want to look at the tax bracket, see where you are, and do a little bit of a Roth conversion, maybe to get you to the top of that tax bracket, but definitely not to push you over into a higher one. And you could do one of these every single year if you wanted to. Hey Sharon, thank you so much for watching. I really appreciate that. You're welcome. Okay, another thing that a lot of people will ask me, I had a client just ask me today, should I, if I'm leaving the federal government, roll my TSP into an IRA because I've got a financial company who's really putting a lot of pressure on me to do that? Of course they are. Because one, they may make money on what they're trying to get you to invest in, either by getting a commission on that, depending on what it is, or by charging an administrative fee. If you are a federal employee or a member of the military, please know that one of the biggest benefits of TSP are the very, very low administrative fees. On average, we pay about 1/5 of what other companies are charging to manage money. So unless you want to invest in something that TSP doesn't offer you, examples that I give are precious metals. Maybe you want to invest in gold, you want to do real estate, you want to do commodities or things of that nature. Unless you want to do something that TSP doesn't offer to you, leaving your money in TSP can be a good way to go simply because of these administrative fees. Okay, so we're leaving it in, we're rolling it into something else, we're doing a Roth conversion, or we're taking the money out. We can take out part of it. Every time we talk about pulling money, it's a minimum of $1,000. We can take out part of it, or we can take out all of it. If you are doing a partial withdrawal, please be aware that you can do that as often. You can do that as many times as you want to, but they'll only process one lump sum withdrawal every 30 days. So essentially you're limited to being able to do that once every 30 days, but you could do it once every single 30 days if you want to. Another thing I want you to be aware of is the fact, I make a big deal of it. I know that, I sound like a broken record sometimes, but it's important. TSP is not an IRA. If you pull a tax-deferred IRA under the age of 59 and a half, in addition to paying your regular income taxes, you also have to pay a 10% penalty tax for early distribution. TSP is not an IRA, it functions similarly to one. So you can pull from your TSP under 59 and a half and not be subject to that 10% penalty tax. This is true so long as it is the year that you will be turning 55 or older when you leave your federal employment, or if your special provisions, which includes firefighters, law enforcement, air traffic controllers, as long as you are leaving under special provisions and you are 50 or older. And again, you don't have to be that age. It has to be the year that you're turning 50. So, it's January. If your birthday's going to be on December 31st, like Sharon, you could do it immediately. You don't have to wait until you have your birthday. You just have to be in that year before you pull. And as long as that's true, you pay taxes. You don't pay the 10% penalty. For some reason, a lot of people don't know that. And again, it is because we get confused because we think that this is an IRA. Those are IRA rules. They do not apply to TSP. Another option is electing payments from your thrift. You have an option of getting a monthly, quarterly, or even once a year payment. You can set that dollar amount, which you are free to change whenever you feel like it, or you can ask them to do it for you based upon the IRS life expectancy tables. You can start and stop and restart these payments whenever you feel like it. You can switch between the dollar amount and life expectancy and back if you want to. Completely up to you. Very, very flexible. Another thing that you could do is annuitize your TSP. Now, an annuity is an investment vehicle that guarantees you an income stream for the rest of your life. So you see a lot of financial planners selling these things. You see a lot of financial companies that are selling these things. Through the TSP, it's offered with Metropolitan Life Insurance Company. You don't have to give them all of your money. You give them increments of $3,500. But the more you give them, the more they promise you. So we've got a single life annuity. We have a joint life annuity, either with your spouse or with an insurable interest survivor. Single life. I give them the money. They give me a promise that I will receive a monthly payment for them every month as long as I live. Okay, so you can see the benefit of this is if I live for a really long time, I potentially get more money from the insurance company than I had to start with. My investment has a finite amount of dollars, right? There's a bottom to that. And if I live for a really long time, or if I pull out too much, or if there is a crash in the market, I can run out of money. If I take that money, give it to the insurance company and buy an annuity, that's never going to happen. The promise is I will get money every month for the rest of my life. However, the promise is only that I will get money every month for the rest of my life. So the potential downside is this. Let's say that my account balance is $500,000. I say, hey, listen, MetLife, I'm going to give all of this to you. You've got to send me a monthly payment every month for as long as I live. Great, we agree. And a month later I die. That was my life. So the money doesn't go to my survivors. It would have if it was in my financial account and I die. I designate a beneficiary to receive that money. But my money went to the insurance company under this contract. They promised money for my life. My life is over. They get to keep the money. Same thing with that joint life, same thing, whether that is with my spouse or with an insurable interest survivor. Now, there are some provisions which will allow me to get a sub option with my annuity. Okay. The single life and the joint life both offer a cash refund option. With that, it looks this way. Hey, MetLife, listen, I'm going to give you $300,000. You've got to send me monthly payments until I get a total of $300,000 back from you. If I die before that happens, whatever's left of that $300,000, give it to these people. Okay? It costs me something. I have to pay for that. But at least then it is guaranteed that somebody is going to get that $300,000. The other sub option is a 10-year certain clause, and it only comes with the single life. It doesn't come with the joint life. Looks like this. Hey, MetLife, listen, here's my money. I'm buying a single life annuity from you, but you've got to promise to send me money every month for at least 10 years. If I don't live 10 years after you get the money, then whatever's left of that decade of payments, give it to these people. So I can do the annuity. I may want to consider getting the sub options. These do work very well for some people, but they are definitely not for everybody. And if you're considering buying an annuity, you need to know, what is it going to cost you? And what's the potential downside of that, so that you can make sure that you're taking care of not only yourself, but also your family members. There are a couple of calculators that I wanted to point out in tonight's briefing that you may want to check out. If you're a federal employee or a member of the military, you can log into your TSP account, tsp.gov. If you haven't been in there for a while, you're going to have to reestablish your account. They changed over this summer. Reestablish your account. You can log in there. They've got a number of calculators. One of them is a retirement income calculator where you can just do some modeling and simulation for yourself to say, okay, if I'm pulling out this much money every month, how long is my money going to last? If I get the annuity, what does that look like? If I give them X amount of dollars, how much are they going to give me, etc. So really good calculator right there on TSP's website. Not everybody has access to that, of course. There are a number of others. The one that I've pulled up here, now I don't work for any other company, right? I own my own company. Pinnacle Personnel Services belongs to me. I subcontract with the federal government. I go out, I teach classes for federal employees. I do contracting with federal employees themselves one-on-one, but I'm not paid by any other company. So I don't want to particularly tout one over the other. This happens to be one of the calculators, but there are many out there, and you can simply do a search on your favorite search engine for retirement modeling calculator and pull it up. But here I'm allowed to type in how much money I have in my account, what it's currently making me and what I think it's going to make me as I go through time, how much am I pulling out, and it will tell me, okay, if this is all true. So I had $250,000 in there, currently making 6%, planning to withdraw $1,500 every single month, and increasing my withdrawals by 2% per year because inflation, right? Stuff is going up, so I don't want to just lock myself into that 1,500. And it'll give me this nice little chart that says, okay, if all of this works out the way you're expecting it to, your money is going to last you this long. It's a really, really nice planning tool if you're looking at going into retirement. I was talking to another client this afternoon. It's been a day of consults. I was talking to another client this afternoon, and she said, this is really scary. I've been working for the federal government for almost 50 years. Yes, retirement can be super exciting. This is something that we work for from day one, right? We start the job wanting to know, like, when can we retire from this job? We look forward to it. We talk about it. We plan for it, or we don't. But we always are looking forward to that retirement. When it actually comes and it's time to put pen to paper and you're standing on the ledge ready to step off into retirement, it can be really scary. Because now we're talking about you not having a paycheck anymore. Now we're talking about you having this locked in amount. Can you live on it? What about if prices go up? What about if the market drops? Do you have enough money to be able to sustain yourself in retirement? It can be very frightening. So taking the time ahead of time to use many of these calculators, to go to classes to learn about retirement can be very, very beneficial. And that's what she said today, just like, thank you for at least giving me some level of confidence, because the more I know about planning for my retirement and trying to figure out my numbers, the better I feel about it. And I'm not saying you have to come to me. I'm saying there's a ton of stuff out there right online. You can go online, you can search for stuff, and you can figure this out for yourself. It is really, really important. So there are all of your TSP withdrawal options, both while you're still employed by the government and after you leave the government. As always, if you have questions or comments, let me know what they are. If you're watching right now and you've got something on your mind that you want to ask, type it in there. I'm happy to answer right now. If you're watching this on replay, type it in there. I'll get a notification that you left me a message. I'm happy to answer. You can always send me a personal message, or you can send me an email. My email is debbie@pinnaclepersonnelservices.com. I hope you have a great weekend. We have finished our first week in 2023. No doubt this year will fly by just like every other year does, but I hope it's been a good first week for you. I hope you have a great weekend. Thank you so much for watching. Take care.